Okay, here we are, here we are. Well, I'm not sure that you always have to pay tax, but let's just assume that that's a correct statement from our presenter there. There are ways not to pay tax. When people talk about my books and they say, why does it say 100 ways to save tax? Does it actually have 100 ways in the book? And what I usually answer is, if you can't find at least 100 ways to save tax when you've gone through my book from cover to cover, then I will refund your purchase money. This morning, I'm not going to be talking about all those ways to save tax that are mentioned in my books. I'll be going through a selection of them. And we're talking initially about investment properties, because that's what I am instructed to talk about, investment property. So we're talking initially about the income from your investment property and what the tax situation is and how you can reduce or mitigate your tax liability. And this is partly about the kind of deductions that you can claim from your rental income. One of the things, important things to be aware of about tax on rental income is the source of income. It may sound like a very simplified statement to say that land is where it is. If land is in Malaysia, it's in Malaysia, we know it, we can see it. Because land cannot move, at least not in the time scale of years that we're contemplating rather than eons. Land cannot move from one place to another. And as the law says that the source of income from land is the land itself and the location of the land is settled, we know very well whether we have income from Malaysia when we have property income. Why is this so important, this thing about the source? Well, it's important for several reasons, but two of them I will tell you. One is that if you are a foreign investor in Malaysia, and there are a lot of them, as we were learning from previous talks, a lot of foreigners have invested in Malaysia, and they are hopefully renting out their properties and deriving an income. What the source issue tells us is that wherever you come from, whether you come from Singapore, Taiwan, Korea, Hong Kong, if you have bought a property in Malaysia, and when we talk about property, we're talking about property which derives its value or right from the occupation of land. So it may be a landed property, it may be a strata title, but if it sits on land in Malaysia, then the source is Malaysia. And as I say, wherever you come from, you have to pay tax in Malaysia on the income derived from your property. So this is one thing that the source doctrine tells us. Another one is what it tells us as far as Malaysian residents are concerned. Because Malaysian residents are exempt from tax, income tax, on any income derived from a place outside Malaysia, with few exceptions that don't concern us here. So the other thing the source tells us is if your property income is from outside Malaysia, you're exempt from tax. But of course, if it's in Malaysia, it's not exempt. All right, that sounds very simple. But all right, let's assume we're talking about land in Malaysia, property in Malaysia, and therefore a tax liability on income derived from it. That income might be rent, or it might be certain other things that you derive from the property itself. It could even be fixtures and fittings within the property, and that's also rent, and the source is where it is. But one thing that's important about property investment and income from it, we have to decide whether we're talking about passive investment or active investment. I'll talk a little later about active investment, because that means that your income can be taxed as business income. Initially, I'm talking about passive investment. And for each property interest, you treat it separately as a source of income. And what you have to do is to look at each one and look at the deductions you can make from that rental income. The deductions that you make from rental income are governed by what is known in the tax world as the wholly and exclusively rule. This is actually a statement which is contained in the Income Tax Act. And what it says is that the expenses which you seek to claim as a deduction from your rental income must be wholly and exclusively incurred in connection with the earning of that income. What it's telling us is that the nexus between the income and the expense, and the linkage there is the property itself. You must be able to show that the expense you incurred did actually relate to the earning of income from property. That's easier when you look at certain kinds of expense, which we'll do in a moment. But one thing you have to be careful about, and this is where you can save tax or tax can cost you, is that no expense is deductible if it is incurred before your first letting arises, before the time when you first receive rent. And as you know very well, if you're getting a property ready for letting, you can incur a lot of expense. You're probably going to be doing renovations. You're probably going to be doing advertising, paying an agent, all sorts of things, putting fittings into the property. All these expenses you have to look at carefully, because it's true to say that if they are incurred before the first letting, none of them are tax deductible. So this is one thing you have to be careful about. Timing of expenditure. If possible, some of the expenses you might be able to defer it until you've actually got some rent coming in. Not always possible, but you need to be aware of the situation. Renovations. People in Malaysia talk about doing renovations. To me, the word renovations is, look in the dictionary, it means making something new again. In other words, it became dilapidated and you have renovated it back to previous standard. But when people in Malaysia say, I bought a property and I'm doing renovations, it's a newly constructed property. The developers just hand it over. And then you have the contracts going to come in, ripping things out and building new things, building walls and removing ceiling panels, doing all sorts of things. You call it renovations. What you have to decide is whether the renovations you're doing actually would attract any kind of tax deduction because you're repairing something. But generally speaking, renovations might attract, the cost of renovations might attract no tax deduction at all. The other thing to be careful about is void periods. You can actually treat expenses incurred between one letting and another as a deductible expense. If during that period when you're receiving no rent, the property is still available for letting, or it is actually under repair at that particular time. So that's another thing to watch out for. You don't have to be afraid of incurring expense in void periods, but what you have to be aware of is the fact that if the property has become totally unusable, or you're not actually making it available for letting by offering it for letting, you cannot deduct expenses that you incur in that void period. And you might incur a lot of expense. You're doing renovations, perhaps. You're doing structural repairs. You're incurring expense on various other things like your assessment tax and your quit rent. Common deductions is what we have here. These are common deductions that you can make from rent, assuming you have actually begun your first letting. Repairs and maintenance, service charges, agents' fees, legal fees. Here we're talking about agents' fees for either for rent collection, agents' fees for negotiating a new tenancy once your first tenancy has begun in relation to that property. What you cannot deduct is agents' fees and legal expenses, stamp duty incurred in connection with the first letting, because that is first letting costs which are not tax deductible. Insurance premiums, of course, if they relate to the property. Interest expense too. And when you talk in terms of property income, you find that your tax cost is probably one of the biggest expenses that you have to bear. And it may be even bigger than the interest cost on your borrowings, or it may be less. But one thing that's important, and you don't want to lose out on, is any tax deduction you can get for the interest you incur on a loan. Here again, you have to follow the rules. You can have a deduction for the interest incurred on the loan if it is money laid out on an asset held to produce income. Now you need to consider those words very carefully, because in most cases we're going to be talking about a loan which is raised specifically to buy a particular property. You don't have a problem with that, because you can see it's there. The loan is related to the property itself. But sometimes loans are taken out and they're used to buy two properties, or the loan is used partly to buy the property and partly to do something else. Now, what I said before about the date when your letting commences, I'm talking the mic now, so maybe you were not hearing me. Are you hearing me now? Yeah. If you incur money or interest expense on a loan and the interest is incurred in the period before you commence the first letting, you will not get any deduction for the interest incurred in that period. The interest deduction only occurs once the first letting has commenced. But as I said before, if you have a void period when you have no tenant and you're looking for a tenant and offering the property for rent, you can have a deduction for the interest you incurred in that void period. You have to look at it property by property. You have to identify the interest expense with the particular property concerned, and you have to calculate your income in respect to each property separately. Islamic finance is often involved in the purchase of a property, and as most of you probably know, under Islamic financing there's no interest expense, because Sharia law does not permit the charging of interest. But what happens there is that the lender, usually a bank, will purchase the property and then sell it to the real purchaser at a higher price. So no interest is charged, but there is a cost to the buyer, which is this higher price that is charged by the banker. And what the law says is that where this happens and expenses incurred in connection with Islamic financing, it can be treated in the same way as interest. In other words, the extra expense that you incur in paying for the property to the banker is regarded as deductible interest. It's not, in other words, it's not interest, but it's treated as though it were interest, and you can deduct it from your rental income. Foreign borrowings also, you must take some care over. If you're borrowing from overseas, in respect of the purchase of a property in Malaysia, you're probably looking for a deduction for your interest expense against your property income from Malaysia. But what you have to be aware of is withholding tax, because when a resident pays interest to a non-resident, tax must be deducted at source. And if that tax is not deducted, it means that you cannot claim a tax deduction for your interest expense. So you may want to watch that very carefully. Now, I did say that you must look at each property separately and calculate the net income from it separately. And that holds true as a general principle. And it could be a bit unfortunate if you had to calculate each property separately, because sometimes you might find that the expenses They're actually more than the income, and therefore you have a deficit in respect of a particular property. This often happens where you have interest expense incurred in a period when you're not receiving much by way of rent. But fortunately, this need not be a major problem, because although you must calculate the income separately for each property, when you've got to the end of it, you can merge them all together as though they were one source of income. And what that means is that where you would otherwise have had a loss of relief for expenses incurred on a particular property, the merging of them helps you to offset excessive expense on one against income on another. In other words, it's what's called the aggregation basis. You aggregate together all your lettings and you're taxed on the net amount. However, what you don't get is any carry forward. If you have a deficit on a particular property, the aggregation allows you to offset the deficit against rents from other properties, provided that the rents from other properties are more than the deficit. But when your deficit is greater than your rents from other properties, there's no carrying it forward. You can't carry it forward to future years. You can't offset it against any other kind of income. That is where you're dealing with property as an investment source, passive investment income. It's different where your income falls to be treated as business income. And that's what other people strive for. There are several reasons why you would want your property income to be business income. One is that all properties form a single source. It's not a case of calculating income from each property separately and aggregating like it was with the investment income source. They are from the beginning treated as one source. It's a business source. So everything comes in by way of rental income is your income on one side. Everything goes out by way of expenditure on the other side, and the net amount is your business income from that property. Well, what difference does it make? Well, of course, it makes a difference in the sense that when you have a deficit, for example, you can do something with it. You could, if you had a deficit overall, you could carry it forward for relief in future years. You may also be able to offset a loss in another source against a surplus of business income from letting. In other words, if you were, taking a simple example, if you were carrying on a retail business and you incurred a loss in that retail business, but at the same time you had properties which could be treated as business income, you could offset the loss from the retail business against your income from the investment properties, which are treated as business income. So it's favourable in that sense. It's also favourable in the sense of being able to claim more expenses than you would otherwise claim. As I said before, if you're looking at each property separately, you have to be able to apply the wholly and exclusive rule to every expense and say, does it actually relate to that particular letting and the income from that letting? For example, you might be talking about the office telephone bill. How could you say that the office telephone bill relates to the letting of a particular property? You couldn't, could you? So there you would get no tax deduction for it. But if all your properties are dealt with, considered to be business income, and I'll tell you how that arises in a minute. If they're all treated as a business income, even your ancillary expenses like the telephone bill, like some director's fees if you're dealing with properties owned by a company, all of these can be counted as deductible expense. So that's another benefit of having your income treated as business income rather than passive investment income. And the other one is relief for capital expenditure. If your income is business income, you can claim capital allowances. Capital allowances are the deductions that are given on a standard basis for the wear and tear of assets within a property, which might be it might be fixtures and fittings, plant and machinery in a commercial property, for example. Capital allowances can be given for those. Usually, if we're talking about residential investment income, we're talking about renewing items of furniture and loose fittings. If your income is business income, you claim those capital allowances. That's not to say you don't get any deduction if it's passive investment income, but what you get then, you get a deduction on the renewals basis. And the renewals basis means that, in theory, there's no deduction for what you spend on fixtures and fittings, like renewing, changing worn-out carpets and things like that. But the way the renewals basis works is that when you first spend money on those things, there's no tax deduction. It doesn't matter whether it's before the letting commence or after. If it's the first item, the first settee you bought, the first bed you bought, the first carpet you bought, you get no tax deduction at that point. But when somewhere down the road, once your lettings got running, you have to replace items, and the cost of replacing them is allowed as a tax deduction at that point in time. So again, this is something that's worth watching. The thing to be said about treatment of business income is that it is not for everybody. I've outlined some of the advantages of treating your rents as business income, but you have to actually do something about it to make sure that they are treated as business income. You have to be an active investor, not a passive one. There are some new guidelines published by the Inland Revenue in a public ruling last year, number 4 of 2011. And they now set out the basis on which your income can be treated as business income if it's income from rental. And gone are the times when you could count the number of properties, and if you had 4 properties of a certain kind or mix, you could treat the income as business income, regardless of whether you got your hands dirty or not. These days, the public ruling requires that you effectively get your hands dirty. You're required to provide active participation by way of maintenance and management of the properties, which means that you are physically handling things like repairs, exterior maintenance, repainting, upkeep of gardens, swimming pools, all that sort of thing, actively provided. It doesn't mean that you have to do it yourself, you know. And when I say get your hands dirty, you don't actually have to go there in jeans and a t-shirt and do all these things yourself. You could be paying somebody else to do it. That counts as actively providing it. But that is what you need to be doing in order to treat your rents as business income. That's why I say it's only for active investors. What I want to consider now is incorporation, whether property should be held by a company or held by a person as an individual. There are pluses and minuses, of course, but many people want to consider this. It's an issue. In fact, it's an issue that nobody should overlook. You know, if you're a substantial property investor, you should never go ahead without considering whether you should be investing through a company or as an individual. One of the advantages of investing through a company is that you might be able to take advantage of the lower tax rate. The normal tax rate for companies is 25%. The maximum tax rate for individuals is 26%. So if you're a top rate personal taxpayer, 26%, you might gain marginally by paying only 25% as company tax. But the other thing is that if your paid up ordinary share capital is not more than 2.5 million, you can pay tax at only 20% on the first 500,000 of the company income. They're small savings, but they are savings. It's worth remembering them. The drawback about this is that a company is only eligible for this 20% rate if it is a virtually standalone company with a paid-up ordinary share capital of more than 2.5 million. There are some complicated rules which prevent a company from claiming this small rate if it is involved with another company which itself has a paid-up ordinary share capital of 2.5 million or more. So this is the other thing to be looked at. Having said that one of the advantages of being within a company is a 20% rate, it might not even be there if your corporate structure is a little bit complicated. The other thing to be said about properties held by a company in relation to income treated as business income is that it doesn't always work when it's in a company. Because if your company is an investment holding company, and I'll come in a moment to talk about what that is in tax terms, if your company is an investment holding company, unless it's listed on Bursa Malaysia, then you're not entitled to treat your property income as business income, even though you might be getting your hands dirty by managing it actively. So that's another drawback. It's a problem about having the way your company is structured as an investment holding company. I've told you about some of the advantages. Well, the advantages within a company, if you do manage to have your rents treated as business income, include relief for losses, as I've said before. They also include group relief. Group relief is where you have another company which makes a profit and your company is making a loss, or vice versa. And you can set the loss in one company against the profit in the other, up to the extent of 70%. This is a bit complicated, and you might not always get away with that, but it may be there as an advantage if you're also involved in another loss-making company. But of course, it involves a degree of control that may be troublesome, 70% control. Advantages within a company of treating income as business income. One of them used to be a very active and useful advantage when we had a different system for taxing dividends. As most of you probably know, since 2008, companies have gone on to the single-tier dividend system, which means that the company pays tax on its income, most of it 25%. It pays out dividends with no tax deducted, and the shareholder can treat those dividends as being tax exempt. In other words, all the liability for tax falls on the company, not on the shareholder. When it was the other way around, when we had the imputation system, the shareholder would have, most of you probably experienced this, have a tax credit in respect of a dividend received. And that meant that if your tax rate was something less than the standard rate, like 26%, then you could get a tax refund. And that was useful as a way of, as an advantage of spreading the income around by paying dividends to close family members like mothers-in-law with low tax rates. And by doing that, you could spread a company's income so less tax was paid. I'm explaining all this just to tell you it doesn't apply anymore. I'm sorry about that. I'll give you the good news before the bad news. That cannot apply because now companies must pay single-tier dividends unless occasionally they happen to have had a build-up of taxed income before 2008. That not many companies are in that position anymore. So what we're left with as a means of spreading income mainly is paying out directors' fees. And this can be done. Again, you can pay directors' fees to wives, fathers-in-law, mothers-in-law, grandparents with low income. But you must be careful because the payments must be justified. You can't just make directors' fee payments and then expect to get it as a tax deduction from your property income, because the wholly and exclusively rule applies. So in other words, your father-in-law, if you're paying him a director's fee, must be doing something active to justify a tax deduction. Not as easy as it used to be, as I said, income spreading. Not impossible, but it can be done. Now, what is an investment holding company? I talked about this a little while ago, about the disadvantage of having an investment holding company, because really you want your company income from rents to be treated as business income, so you get more favourable tax treatment. But if you're going to be an unlisted investment holding company, it doesn't work. So what is an investment holding company? Well, an investment holding company is a company whose activities consist mainly in the holding of investments, and not less than 80% of its gross income is investment income. In other words, there are two legs to this. The question of whether activities consist mainly in the holding of investments is a subjective one. Most companies will prepare a director's report in which they state their principal activity. And this question will obviously often be solved by looking at the director's report. But director's reports are not always very explicit. They may say something rather vague. And so you still have to decide whether, in fact, the company's activities consist mainly in the holding of investments. If they don't, then you're out of the wood. If they do, you then go to the second leg of the requirement, and that is that 80% of its income, or at least, consists of investment income. For this purpose, you can disregard any property income where there is active participation. In other words, the kind of active participation that's necessary to categorize it as business income. All this is rather complicated. So I'm going through this fairly briefly because it is so complicated. A lot of it's explained in my book, so I don't want to explain it in detail here. Except to say this, that one of the disadvantages of having a company which is an unlisted investment holding company, something you want to avoid if you can, is that the general expenses of running a company, running expenses, directors' fees, things like that, only get a very minimal deduction, which is done on the basis of this formula here. I don't think you need to memorize the formula, but you may see, if you put some figures there and try to work it out, that you would end up with not much deduction out of the total expense you've incurred. So we're talking here about all the directors' fees, wages, etc., to workers, management, secretarial, audit and accounting fees, phone bills, printing and stationery, rent, all these expenses that are normally incurred by a company and are charged as an expense of the company. If it's an unlisted investment holding company, it only gets a deduction based on this formula here. And there's one thing that I didn't include there. Even when you've gone through this calculation here, A times B over 4C, you then have to calculate 20%, 5% of B, and that's the maximum you could have by way of a deduction. So that's one of the disadvantages, again, of having an unlisted investment holding company. The other one, as I said, is that you can never then treat your rents as business income. So let's turn away from the treatment of investment income and look again at what you might realise when you want to dispose of the property. In Malaysia, there's no capital gains tax, no general capital gains tax, but there is a real property gains tax, as most of you probably know. And the real property gains tax, if you held a property for less than 2 years, it's 10%. That's the rate under the recent budget. If you've held it between 2 years and 5 years, the rate is 5%. If you've held it for more than 5 years, it's nil. You don't pay any tax at all. These tax rates are kind of concessionary rates because it's still written in the law that the rates are whatever they were before the real property gains tax was abolished a few years ago, with a maximum of 30%. So at any time, the government can just pop up and withdraw the statutory instrument that sets these rates, and we're back on the 30%. So be aware that it's not set in stone. One thing I want to say is that real property gains tax is not an alternative to income tax. Some people think that it is. Some people have the idea that if they have not held a property for a very long time, and they're a little bit worried that they might be subjected to income tax on the gain on disposing of it, they think that if they submit to real property gains tax and pay that, they're safe. They're not. Because the Inland Revenue can at any time raise an assessment to income tax on a capital gain, and then they will vacate the real property gains tax assessment. So it's not an alternative. What you need to do is to make up your mind which way you want to play it, which way it's likely to be played, and act accordingly. Under these days of self-assessment, you're put in a quandary. And that applies even where you've held a property for more than 5 years. Because if you suspect that you may be subjected to income tax if the Inland Revenue knew all the facts, what do? Do you tell them or do you keep quiet? Well, you really didn't have any means of telling them these days, because if, assuming that it's more than 5 years and you don't have a real property gains tax liability, what you would do if you thought you had an income tax liability is to put it on your income tax return form. We're under self-assessment. You don't have to tell the Inland Revenue anything except whether you're going to pay tax or not. So this is your dilemma. And it's likely that we're talking about a period of less than 5 years, because probably after you've held something for 5 years or more, the danger of being subjected to income tax is minimised. It would be in the first 2 or 3 years, a quick sale, where you might be liable to income tax. And that's where you have a dilemma. Are you going to submit to real property gains tax and not declare it for income tax? You could have made a disastrous mistake by doing that, because, as I said, paying real property gains tax does not free you from income tax. You still didn't put it on your income tax return, and once you found out, you can be penalised for non-declaration of income. At the very best, that could be a late declaration. At the very worst, it could be deliberate omission of income. Well, how do you decide whether you should pay income tax or not? Not easy. If you're carrying on a trade, if you're doing property dealing, that's quite straightforward. But we're not talking about that here. We're not really talking about a situation where somebody's dealing in properties and deliberately buying and selling over a short period of time. That would quite obviously be a taxable business. We're not talking about property development, where a company has a land bank and from time to time commences a development. Once again, there is a method of taxing that, because that's a business activity, a business income. We're talking about what is maybe sometimes what is commonly known as flipping. I think everybody knows what this term means. Flipping generally is taken to mean buying a property, signing up for a new launch in the hope that you can fairly quickly pass it on and make a whacking profit out of it. That's what I think people mean by flipping. Are you taxable or are you not taxable? Well, it's never easy to say. I mean, it would be easy to say, yes, you are, and that settles the matter, but that's not the answer that people want. The answer that people want is, no, you're safe, you're not taxable. What you have to look at is not just whether you're doing a business deal or not. Are you doing an adventure in the nature of trade? That's what the Income Tax Act refers to. That is what is subject to income tax. Not only income from carrying on a trade or business, but also income from doing an adventure in the nature of trade. And that can include a one-off transaction. It doesn't mean that it's something you're doing regularly. It can be, the test can be applied to every property transaction you conduct. Was it an adventure in the nature of trade? What does in the nature of trade mean? Well, trade means deriving profit from a transaction with the intention of doing so, doesn't it? So, obviously, intention is very relevant. What did you intend when you acquired the property? Did you hope that sometime in the future you might dispose of it at a profit? Nothing wrong with that. Everybody does that. Nobody will be foolish enough to buy a property without thinking that the value might go up and you can get more for it in the end. There's nothing wrong with that. But the question is, did you actually cross over the border? Was resale at a profit the uppermost motivation in your mind at the time when you acquired it? I can't tell you. Every situation differs. But sometimes you know by looking at what we call the badges of trade, which I'll have a look at in a minute. You know, whether your hands are really clean or whether they're not. One thing I wanted to say before I leave this particular slide here is that the difference between a company and an individual in this sense. It was said in a case that was decided in the Malaysian High Court many years ago, I think it was the Federal Court, that a company comes into existence for a particular purpose, but an individual comes into existence for many purposes or sometimes none at all. Well, I mean, what that infers is that when you look at a company, there's a purpose there, and if that purpose is making money, then it's more likely when a property is held by a company that the company will be deemed to have made a gain in the nature of income than in the case of an individual. An individual, as was said in that case, comes into existence for many purposes, sometimes none at all. And would you look at yourself and say, for what purpose did you come into existence? No. You came into existence because your parents did something that started you growing in your mother's womb. They didn't have a purpose in mind for you at the time. So that's the point about an individual. It's easier for an individual to say, I didn't intend to make a profit, at least that wasn't uppermost in my mind when I acquired the property. It's easier for an individual to say that than it is for a company to say that. And as I say, intention is uppermost. There was a case, Malaysian case, which involved land on which one of the KL shopping malls was built, where the person developing the land had actually acquired this land by inheriting it from his father. And that has a lot to say about intention, because he was held not to have acquired the land with the intention of selling or developing it, because he inherited it from his father. He didn't actually go out and do a deal or scout around for a piece of land to buy. He didn't do any of that. It came to him because his father wrote it in his will. So this is where this comes again to this point about intention. If you acquired a property with the intention of making a profit, you're much closer to having a taxable profit. What this fellow did, he didn't acquire it with any intention at all. It was like coming into the world as a baby. You didn't have any intention. There was no particular purpose in what happened. So here's the difference. Intention is crucial. Now, badges of trade. This is something that applies not just to property investment, property development. It applies to any kind of activity, like buying whiskey or things like that. It can apply to carrying on an activity of buying and selling antiques or something like that. It can apply to a hobby kind of activity, where a person enjoys doing a particular thing, like repairing old machineries, and then suddenly it becomes a money-making activity rather than a hobby. Badges of trade. This is what we have to look at. There are several of these, what are called badges of trade, which help to decide whether what a person did is an adventure in the nature of trade or not. And there's no particular one that will give a finite answer to this. You have to look at all of them, and then on the basis of your examination of all these, decide whether that particular situation actually looks as though it's not a clean hands situation, it's a taxable situation. One of them is the nature of the asset. What kind of asset? Is it suitable for personal use or as trading stock? There was one particular case which I often like to quote. It's an old case that was decided in the UK many, many years ago, where somebody went from the UK, and he went somewhere in the continent, I think Poland or somewhere like that. And he came across the opportunity to buy a large quantity of toilet rolls. It wasn't just 10 or 20. It was like, like 100,000 or something like that. And he bought them up and shipped them back and sold them. And he'd never done business with toilet rolls or anything like that before. It was only a one-off thing. But that came to the court. And what scuppered him in this particular case was the nature of the asset. Nobody buys 100,000 or 1 million toilet rolls for the sake of looking at them or papering his walls in the house with them or anything, or using them personally. Who could ever use 1 million toilet rolls in a lifetime? So this was what caught him out, the nature of the asset. Same applies when you're talking about properties. Property is inherently, I suggest, an asset where people may buy it for personal use. You know, any one of you go out and buy a house or a condominium and you want to live in it yourself. Maybe your wife or your husband likes that particular location. So we don't say a property must always be unsuitable for personal use, because it often is suitable for personal use. We need to look at also the circumstance in which it's bought. If you've got 2 or 3 residents already, and you go book 10 condos in a new launch, why would you do that if you wanted it for personal use? Ask yourself. Next is time between purchase and sale. Some people think this is the only factor that is relevant. It's not. It is a leading factor in deciding whether there is an adventure in the nature of trade. If you pop something off as soon as you can, then it doesn't look good. The longer you hold it, the better it is. But there's no particular point in time at which you can say, you're now safe. I did say a little while ago, when you've had something in 5 years, yes, you're probably safe. But that doesn't mean that's not entirely so. It's just depends on the amount of time. Number and frequency of transactions. As I said, the fellow in the toilet roll case, he'd never done this kind of transaction before, so that was in his favour. If he kept on doing it, going every month or every year, go to Poland and buy 1 million toilet rolls and come back and sell them, that would be against him, wouldn't it? Same with you with properties. If you keep booking a property in a new launch, or booking 2 or 3 and selling them off and doing the same thing every year or every 2 years, doesn't look good, does it? Again. Supplementary work to improve marketability. Well, this would apply to development. Suddenly you come across this like a dilapidated old house, and you think, oh great, I can knock that about and make it into four flats, 4 Soho units, and sell them all off for a higher price. That's supplementary work to make it more marketable. Again, it's a black mark against you. Not convincing by itself. Manner of acquisition. Well, this again comes back to what I said about the fellow who inherited property from his father. That's quite clean, isn't it? There's nothing implied by the fact that a property was given to you, or it may have been given as a gift. But if you go out and actually scouting for a property and buy it, then maybe that doesn't look so good. But again, as I said, nothing by itself. Method of sale. Look for highly organised activity. Depends upon how you go about it. Profit-seeking motive. I talked about that. There's presumed to be a profit-seeking motive in the case of a company. Trading interest or special knowledge in the same field. I think most of you here can relate to that, because most of you are in a real estate business. So if you use your position or your experience and knowledge in not only acquiring but also disposing of a property, then that would be a black mark against you. As I said, not one factor by itself is conclusive, but that would be a conclusive factor with you, whereas it wouldn't be a conclusive factor for me, because I have no special knowledge or permission in relation to real estate. And finally, the final point to look at is the method of financing. Most people, when they buy a property, they need to borrow money in order to acquire it. If you take a housing loan repayable over 20 years, that looks as though you're intending to hold the property a long time, doesn't it? If you take a short-term finance from a company, which is to be reviewed after 6 months, what does that indicate? It indicates that you don't have a long-term intention for holding that property. So that's what this one is about, method of financing. How did you finance it? Could you afford to keep the property and service the loan? If the answer is no, then it's black again, isn't it? So this is what we have to go through, badges of trade. And just before I wrap up, I'll just remind you again of the point of all this. The point of all this is that you should not expect to get away with only real property gains tax, because it's not an alternative to income tax. You should look carefully at property transactions you do or your clients do, and look at all the badges of trade. And if it appears that there may be a liability to income tax once a sale has taken place, you must examine very carefully the situation you're in and decide whether it would be safer to declare the property and pay income tax on it, or whether you really want to ride bare-knuckled and hope that you never get caught, in which case it would cost you a lot more. I think I've come to the end of what I had to say, and I thank you very much for listening. I hope it's been useful. You have a